It's the all-new GenWealth Radio Hour. Welcome to the What's Happening segment. My name is Scott Inman, GenWealth co-founder Janet Walker here as well, as we spend the next few minutes talking to you about, what's in the headlines across the financial news spectrum. Our marketing team scours the headlines, checks out what's trending on social media with regard to your money, finances, investments, and finds a few items for us to discuss. And, you know, if you were with us a couple of weeks ago, Janet was on here and she did a lot of discussing. Sometimes we agree with what's on there, and sometimes we pick it apart.
Yeah, we strongly disagreed that time. Today, I don't feel like we're stirring up quite as much, maybe, question about what the content is, but still some good discussion to be had about what's being discussed out there.
Yeah, I think for me, this one just grabbed my attention because of the headline. So there is an All-Spring Global Investments 2025 retirement study out there, and there was an Investment News article written about it. And the headline, you see it there if you're watching on the video version of the show, just 6 in 10 feel secure about retirement. And it, of course, goes on to say it requires smarter, tailored planning advice. But this survey finding that they surveyed 1,515 adults. I don't know how they come up with that number, 1,515 U.S. adults. They were all retirees and near retirees who have at least $200,000 in investable assets. And they asked them some questions, and only 60% said they feel financially secure in retirement. And I guess for near retirees will feel financially secure in retirement. And that's a decline from the prior year, but it also is very eye-catching to know that 40% of Americans in this survey do not feel financially secure in retirement. So we're going to kind of dive in today and look at this and really kind of talk about why it matters, but also what can be done about it, because we would really be failing if we don't give you some action steps to if this is you, if you're one of those 4 in 10 that don't feel secure about retirement, what can you do about it?
So I want to focus on where they say this confidence fell during this time period. It fell most sharply among women, older near retirees, and younger retirees. So both ends of the age spectrum there relative to their retirement timeline. And those groups are already at a higher financial stress risk. And Scott, one of the things that you've heard me say many times over the years is that I believe that education is an antidote to fear. When we talk about a lack of confidence, another way to say that is people are fearful. They are fearful that things are not going to work out in their retirement. So what do they need? They need education. So if you fall into one of these categories, or even if you don't fit the group that they've seen this increase in the lack of confidence lately, even if you don't fit those categories, if you're not confident, the solution is education, Scott.
Yeah, so when you think about that, if you dive down into the particulars, the details of this, one of the other things that stood out to me is it talks about traditional one-size-fits-all solutions that might not be adequate. There was a large group of people here that, in fact, I think it was 84%. Yeah, 84% of near retirees reported preferring alternatives to what are called target date funds. And it points to a growing desire for flexibility and personalization. And when you think about the advent of target date funds, and I just mentioned it being traditional, it really isn't that old that these things were created, but they have been around for a long time now. And it has made investing in your 401k or other employer-sponsored plan a lot easier. You choose, if you've seen, if you've got a 401k, you probably know what I'm talking about. Maybe you've never heard them described as target date funds, but when I say this, you'll probably know there's a year on it, right? And usually you pick the year that you plan to retire. If it's a 2055 target date fund, a 2045 target date fund, so on and so on and so on. And it has put the easy button in on the 401k. And from a growth perspective, that might be an easy way to do things. And you might be able to accumulate some wealth that way, especially with what's been going on in the market over the last several years. We've been in quite the bull market for the last 3. But as you get closer to retirement, and you have to start factoring in things like tax strategies and withdrawal strategies, income solving, that target date fund really can be lacking. And I think for a few reasons. I think it can put you, Janet, too conservative too quickly if you're getting close to your actual target date.
Right.
And you're now in a 2025 target date fund, you may be more conservative than you need to be.
Yeah, and it really lacks the personalization. So speaking to how conservative or how growth-oriented you need to be, it completely lacks the personalization. I think about, this is an oversimplification, but people can follow me on this example. Let's, instead of retirement, let's talk about hamburgers, okay? We sponsored a meal for a local football team one evening at GenWealth, and so we sponsored that meal, and because we're planning for, it was close to 100 people, I think, because we're planning for that, like, everybody gets the same burger. It's just, we got 100 of these burgers. You like it, that's great. You don't like it, that's great too, because this is what you're getting. As opposed to if those people were able to go and say, here's what I'd like on my burger, here's what I don't like on mine, and to personalize it. If you're desperate, you'll go for the group order. But if not, if you have the ability to personalize it, it's a way better experience. And again, I know that's an oversimplification, but those target date funds are there to simplify things. Just like ordering 100 of the same burgers, it simplifies things. It does not mean that it is the best fit for you.
Yeah, and I think that does highlight, and it doesn't say in this study how many of the people who responded have all of their money in their 401k, or how many of them work with an advisor, but I do think it highlights the gap that is clearly there for people to have that personalized, not only advice, but plan for the withdrawal strategy, the tax strategy that needs to be in place. And I think you talked about it, the education, but also getting people to engage in a relationship with a financial advisor is a big piece to this, because I do think that if there's a written plan in place and a relationship with an advisor, and you see the scope of everything that is in place for you, it still requires you to have the assets to retire, but if you do, I think it can make you feel a lot more confident about your situation.
Yeah, I think one more thing I would add to this is to think about your proximity to retirement, and don't wait until you're right up on that line before you start meeting with an advisor.
Yeah.
Scott, so many times people who are walking in the door at GenWealth for the first time are telling us, I want to retire, whatever their exact timeline is. It is usually within the next year when they walk in for the very first time. Now, we have many people who come in before that, but if you were to look at our clients as a percentage of when they walked in the door, percentage base, the vast majority are walking in the door when they're close to retirement, and frankly, they don't know if they can retire. We hear over and over and over again, man, they were so glad to hear that they could retire. Mm-hmm. So what's happening, if you take that and just develop it a little bit, what's happening is people are working, and they're investing all along the way, not really knowing what that's going to do for them. And one day they go, you know what, it's getting kind of close. We might actually ought to sit down and talk to somebody. You can change that ahead of time. So just put it on your docket as something that you can do in the upcoming year to get some more confidence in your realm about retirement, at least to know what you're looking at.
That's actually another item we're going to talk about after this next item. So as we go to another story we found from Reuters, the U.S. labor market shifting into a new phase, fewer hires and more layoffs. So it's a trend that could ripple through retirement planning, debt management, and income strategies. So behind the headline here, employment announcements are showing that major firms, including tech, retail, and government sectors, are cutting hundreds of thousands of jobs. And in fact, to put a number on it specifically, between January and September of this year, so the first 9 months of this year, roughly 950,000 job cuts were reported. There's a phrase they're throwing out there now, no hire, more fire, replacing no hire, no fire, which is where firms were before. So they're not aggressively hiring anymore. And they do report that the shift is partly driven by cost cutting, but also by increasing adoption of artificial intelligence. I want to talk about that because that, AI the positive side of AI has been all about the AI trade in the stock market, and that has driven a lot of the gains. There's no question that tech has led the way there and has been a great thing. But what about, and this has been talked about a lot, and we've heard a lot in our industry about what is AI going to do to the job market? Are we going to see higher rates of unemployment? And overall, I think the consensus from the economists we've talked to and the investment people we've talked to, it's going to have an effect, but it also really is not necessarily going to be elimination across the board of jobs, but it's going to be replacement of jobs, and people are going to have to find a different skill set because AI is still going to create jobs, but they're not going to be the jobs that existed prior to AI.
Well, we're going through a process here with our internally at GenWealth with our ownership team and our leadership team, and this will go through the rest of the team next year, what we call a step up, step down process. And it's something we've done in the past too, but this is at this point highly related to the rapid onset of AI here at GenWealth, not just like someplace in California, but what we're doing here. So what are you able to step up into doing that you previously did not have the time to do? And what can you step down from doing that either AI can do for you or that another team member who is more junior to you can do? And it allows a company to scale and be far more efficient. So from the employer vantage point, that's what I see. From the vantage point of a mom and a friend to a couple of different people who I know who are job hunting in their 20s, I know 2 people who have applied to literally over 200 jobs and gotten very few interviews and not been able to move past that because what employers are looking for, it's that, perfect deal that doesn't really ever exist. They're looking for somebody with 10 years experience or more who will accept the pay of somebody who has 0 experience. And so they just keep looking and the applicants just keep applying and they're not getting on the same page of what the employer is looking for and what the applicant is looking for. And again, I say that from personal perspective of people I know and I've talked to through this process that the labor market, it really, Scott, it really is in a different place. And here at GenWealth, with the exception of what we call a client-facing role, so advisors and people who specialize maybe in insurance or estate planning, we don't have current plans to expand our workforce, which has not been the case in a long time. We've grown our workforce a lot over the years, but we see that shift to we can keep our team current, the current team that we have, and cause them to be far more efficient and effective in what they do, which just adds to the bottom line, which then we can in turn share with them. So why would we add additional people? And that's the story we're seeing really nationwide.
So let's talk a little bit about two takeaways for me for near-term retirees. There's kind of more of a macro and a micro approach to this, but if you are closing in on retirement, maybe you're planning to retire in the next 5 to 10 years, what does this news do to you? Does it shake you up a little bit? Does it make you wonder, well, am I going to be one of those positions that AI replaces, or just in general in the more traditional economy that my corporation or my company has to tighten its belt and lay off a few positions to get more streamlined? And where does that leave you? Going back into finding a new job, or do you know you're financially independent, or do you know you're very close to being financially independent, and then you're prepared to potentially retire sooner than you really had planned? And of course, that comes back to the planning process. But we've said on this show before, Janet, that many people don't retire when they think they are going to, and job loss is one of the key reasons. So it highlights the need for a written plan to know if you're on track for true financial independence. Yeah,
the job loss from health reasons in the past has been a key reason that people retire earlier than what they had otherwise planned. But going back to, we keep talking about AI, that influx of AI into really every industry out there, I would say that as you are approaching retirement, be more willing than the previous generations were to reinvent yourself, because if you want to continue working, or if you need to continue working, you may have to do that. And Scott, to just reiterate what you said, that if you're approaching retirement and you're not really sure if you're ready, I think this underscores the need to know if you're ready.
Yeah. And then the second takeaway, if this job slowdown or this job shift of fewer hires and more layoffs in the U.S. labor market does create an economic slowdown or even a recession, is your investment strategy ready? There was another big takeaway here for me. It says, because hiring is slowing and layoffs are rising, the uncertainty around future income streams for those still working increases. That's natural to think about. But for those relying on savings and investments for income, the prudent assumption shifts. What if it takes longer for the economy to rebound? So that really struck me as well, because if you think about retirement income, this article is basically inferring that if you don't get the economic growth, or thereby the stock market growth that you are anticipating to get, how will that affect your future retirement income? And I thought to the way we plan, because when it comes to the way we plan for retirement income, the growth component of that in your investments is not meant to be touched for a long period of time. So the answer for me is, if you've got the ready to retire process behind you, it's not going to affect your retirement income.
Absolutely. And we continue to have to explain that, to people who are new to the process. And I get that. But like a repeat of a 2008 as an extreme example would not concern us in the way that we segment those assets. It makes a huge difference to a retiree to know that the portion of their assets that they are seeing exposed to more market volatility is not going to be used for a decade and a half. Well, that far out after 2008, it's like it never happened. So it can make a huge difference for a retiree. Yeah,
as we say all the time, it's not about the economy, it's about your economy and the part that you can control, because that's just another way of saying control what you can control. What you can control is be ready for all-weather approach to retirement. No matter what the economic situation is, do you have a retirement income plan in place that expects it and can endure it? Some great stuff there from our marketing team, and we'll do another sweep of the What's Happening segment next week. But up next for you, it's the Get Ready for the Future show.
You've been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Continuing our mission to help people discover, protect, and share true financial independence. That's what we're all about at GenWealth Financial Advisors, and this is the Get Ready for the Future show. My name is Scott Inman, along with me, Janet Walker, a GenWealth co-founder, as we get set to answer some of your questions about money, investing, retirement, Social Security. Whatever you've got on your mind, we're ready to take it on. And if you want to get in on the action, you can write this number down, 501-381-5228. Again, it's 501-381-5228. You can shoot us a text at that number. You can also call it and leave a voicemail with your question, and we might just use it on the air next week. You ready to dive in?
Absolutely.
Our first question this week is from Tucker in Little Rock. Our youngest just started college, and we're 56 and 58. We want to help with tuition, but still plan to retire at 65. How do we prioritize, college or retirement? Helping our kids shouldn't derail your future. So let's talk about how to balance both if you can. And it is a common question that we get, especially in this age group of our 50s, where we are planning for our own financial independence, but we also want to not set our kids up behind the curve right away. And I understand that completely. We've dealt with this both personally. And I do think, ideally, if you've got margin in your life, you can do both. You can continue to fund your retirement contributions and be on track for financial independence while also making sure that your kids' college is paid for. But the key is you have to know that you are. Even if you have that tendency to want to pull back the reins on retirement contributions, you have to know what kind of effect that is going to have on your future retirement.
Yeah, so again, it's all about balance, and you have to know if you're on track or not. And the way you know that is working through a plan that's personalized based on where you are in life and what your goals are relative to retirement. And then from that information, you're going to be able to go, okay, yeah, we're on track, or no, we're not, and adjust accordingly. And Scott, I've shared this many times over the years, but I'll share again a story from meeting with clients years ago, because I think it still so well teaches this point about this balance between taking care of kids and maybe beyond taking care of them, maybe doing too much, and then the balance of taking care of your own retirement. So I had this couple come in, and their daughter was not at the age of college yet, so she was still in elementary school. And they had a habit of going to Starbucks on a regular basis, and we were looking through everything, and we were talking about how much they needed to put back towards their retirement. And I wasn't picking on Starbucks, but it just so happened in this scenario that literally if they stopped that one habit, then they would have the amount of money that they needed to contribute towards their retirement moving forward. And the daughter had actually come in with them on this appointment. She was sitting out in the lobby. And the mom laughed at me and she said, "We cannot stop going to Starbucks." And I went, what's the story there? And she said, "No, like, you tell my daughter we're not going to Starbucks anymore. Like, it's a thing. You tell her." And so I was like, okay, challenge accepted. So we go out into the lobby, and I knelt down and got eye to eye with this young lady. And I said, "Sweetheart, I've got a question for you. You've got a choice. You get to pick, okay? You guys can stop going to Starbucks, and when you're old enough to get your own place, you can live at your house, and mom and dad can live at their house, and they can retire, and you can do your thing. Or you guys can keep going to Starbucks, and when you get old enough to have your own place, mom and dad will move in with you at your place because they're not going to be able to afford to retire." And she looked at her mom immediately and said, "Mama, we don't need to go to Starbucks anymore. I'm done." It was an immediate, I think she was, I don't remember for sure the age, but let's say around 10. She got it.
Ain't no latte tastes that good.
No. And it was so funny to me because as the advisor, I was taking a risk because the rule is don't ask a question that you don't know the answer to.
Yep.
And she could have gone the other way, but she didn't. And I think, give credit to your college-age kids that if you will lay this out as these are the facts, not I think or I feel, but we checked the numbers and these are the facts. We can do this or we cannot do this. And that's a discussion you can have.
Yeah, and step one has to be you got to make sure your own retirement foundation is solid. Are you on track for financial independence, doing what you are currently doing? So that gives you some clarity to know what is left to be able to help your kids. And, the other thing, too, Tucker says that their youngest has already started, so the scholarship search may be over, at least right now, although there could still be some that could come later. But there's work study. There are different ways. They could work a job as well, too. I think a lot of that depends on what kind of time spend they're going to have to be on studying. But there are other ways to fund it as opposed to me or you, right? Either borrowing it or getting the cash check from your parents. So I think that's big too. And then the best gift to your kids, I think, is not getting the tuition help necessarily. It's the example of financial stability. I think that's the big piece. Supporting their future should never come at the expense of your own, to Janet's point on the story. And with a little planning, you can do both. And I think that goes back to highlighting, for me, what I say with a lot of people in the meeting room too, is the biggest thing you can do that will be a catalyst to your best financial future is to have margin in your life. And I don't know what Tucker's situation is with that, but the gap, when we say margin, the gap between your income and expenses, it allows you more freedom to do more things, both funding your retirement and helping your kid out with not being burdened by debt in their tuition.
Scott, I'll add one more thing, and this is not really for Tucker because they're farther along, but for maybe where Tucker was years ago when their daughter stopped going to, or it says their youngest, doesn't say gender, when their kids stopped going to daycare. That is an expense that somehow as young couples we figure out how to cover it, and it is hundreds of dollars every month. And then when it stops, that money just disappears into Never Never Land, and we don't know where it goes. If you will, as young couples, when you stop paying daycare, if you will take that money and put it back for your kids' college and maybe for your retirement, you can split it 50-50, however you want to do it. But if you will utilize that money for your future as a family, it's a game changer.
If you want more free info about retirement, investments, and your money, you can subscribe to our YouTube channel. Just go to YouTube and look for GenWealth Financial Advisors. Our next question on the Get Ready for the Future show is from Chuck via text. I turn 73 next year and will have to start RMDs. Is there any way to reduce the tax impact if I don't need the money? Hey, just because the IRS says take it doesn't mean you have to spend it or be taxed to death. Here's how to plan smarter with RMDs, which, if you aren't familiar with them, stand for Required Minimum Distributions. So Chuck's about to turn 73. That is RMD age for him. For everyone born 1960 or later, it's going to be 75. So there's going to come a point in time, if you haven't reached it already, that you are going to be required to take a portion, a small portion, of your qualified account balance. And by qualified, we mean IRAs, 401ks, anything that has not been taxed. That all went in pre-tax, right? And so when it comes out, it has to be taxed. Maybe you've been taking distributions before you've reached RMD age, but if you haven't, you're going to have to take some. And if it's a large retirement account, Janet, that could be a very large RMD.
It absolutely can be, and what a lot of people don't realize is the impact that it has on other aspects of your financial life. Just as a few examples, that because that counts as taxable income when it comes into your household, it can push you into a higher tax bracket overall. It can raise your Medicare premiums. A lot of people don't think about that at all, but your Medicare premiums are income based. So if your taxable income increases, then your Medicare premiums can increase, and it can also cause more of your Social Security to be taxed. So your Social Security, either 50 to 85% of it is taxed, depending, again, on your income. So all of those things can be impacted just by these required minimum distributions. So Chuck is asking here a very wise question about, I've got to take it, but how can I lower the tax impact? Because it really does affect multiple aspects of your retirement income. One of the best tools available for you is what is called a QCD, or a Qualified Charitable Distribution. And basically, here's how this works. And by the way, you don't have to be RMD age. When they extended the RMD age to start later, they kept the QCD, the Qualified Charitable Distribution age, at 70 and a half. So if you're 70 and a half or older, you can do this even if you are not RMD age yet. So if you can have up to $108,000 per year transferred directly, that's a key word here, directly from your IRA to a qualified charity. You can't do it from a 401k or other retirement plans. It has to be from the IRA, and it has to go directly to the qualified charity. It cannot land in your bank account between those two locations. When you do that, the amount of money that you're transferring there counts towards your required minimum distribution, but it is not included in your taxable income.
Yeah, so that's a really big advantage, especially when you think about more than likely if people are already giving to charity, let's say they're regular givers to their church, they're probably not getting a tax benefit in retirement for that, because most retirees do not itemize their tax deductions anymore, so they're only getting the standard tax deduction. So this gives you an opportunity to actually take part now in that. Now, I should say, if you do happen to itemize, you can't do both, right? If you got to send the QCD, and that's where you take it. But it is a great opportunity for charity-minded people to be able to continue their giving, but not have to be taxed on it. Now, there are some rules that you need to be aware of, and you've already talked about the fact that the money has to go directly from your IRA custodian to the charity. If you take the withdrawal yourself and then write a check, it will not count as a QCD, and it only works with IRAs. 401ks, 403bs, employer-sponsored plans are not eligible for those QCDs, although you can oftentimes roll over your 401k, for an example, to an IRA first and then begin issuing those QCDs. The charity must be a qualified 501c3 organization. So things like donor-advised funds or private foundations would not qualify for the QCD. So there are some things you have to remember there and keep in mind, but it is a great way to lower the overall taxation and not push yourself into a higher tax bracket or potentially raise your Medicare Part B premiums. And I think the other thing as we wrap up on this too, Janet, the other thing you can do is to begin a robust withdrawal strategy earlier than RMD age. Because if you think about it, if you wait until you're 73, in Chuck's case, or 75, to take out that first piece, and it's grown for potentially a decade or more while you're retired, that's going to create a bigger headache of having to manage those RMDs. You can begin the withdrawal plan and live on that money, or at least some of that money, when you retire, and that can potentially manage the overall balances better.
Yeah, we're looking at this because Chuck asked about it from a tax impact, but I'll tell you, my church is doing a debt freedom campaign to pay off the building, the mortgage that we have. So that's the reason I'm thinking about it. But really, for any 501c3, you can give more and it still have the same impact to your account value. Yeah. So if you would have withdrawn, let's say $12,000, and given the net amount of that you receive, somewhere between $9,000 and $10,000. So let's just say for round figures, you withdraw $12,000, you get money withheld for taxes, and you donate $10,000. Well, if you do this, you could donate the full $12,000. It's still $12,000 coming out of the account, but you're not having to go the tax route on this. So it's a tremendous game changer, I think, for charitable organizations as well, because you can give, this is round numbers here, but in that example, you could give 20% more than what you would have otherwise given.
This is the question of the week. So, Chuck, we're going to give you a Get Ready for the Future Show tumbler for being named the question of the week. Just send us an email to claim it. Send that to show@getreadyforthefuture.com. And if you'd like to be named the question of the week, well, guess what? You have to send a question in first. 501-381-5228 is the number to leave a text or a voicemail. You can also email your question if you'd prefer. Just send it to that same address we just shared, show@getreadyforthefuture.com. Next up, it's Blake from Fayetteville. We inherited a lake house from my parents, but we don't use it often, and the upkeep is getting expensive. Should we keep it for the next generation or sell it now? A lake house sounds like a dream, but it could become a drain. Sounds like it may be doing that. So let's talk about legacy. Let's talk about emotion and when it makes sense to let go. And I think the first thing we think about when potentially selling a secondary residence, especially one that has been inherited, is we think about the tax issue, Janet, and a lot of that's going to depend on when they inherited it and how much they get for it.
Yeah, so let's just talk about something called basis for just a moment. I have no idea the value of this home. We're going to use $100,000 for just easy math here. If at the time that you inherited this home, if it was worth $100,000 and now it's worth $150,000, then that $50,000 is your gain. It doesn't matter if your parents paid $20,000 for it. If you went through the normal process of inheriting it and you didn't get it like while they were still living, if they passed away and you got it, then you got to step up in basis, meaning that the value on the date that they passed away is what they're going to count as what you invested in it, and anything north of that is the taxable gain. So depending on how long you've had it, you may not have a tremendous amount of gain in this. However, let's look at, just in case, if you've had it a longer period of time and you do have some significant gain in it, you might want to, for tax reasons, you might want to consider doing something called a 1031 exchange. What that is you can sell this real estate property and purchase another one without receiving the gains on it between the sale and the purchase, and it just goes into the next property, and that means that you don't have to pay the taxes on those gains. So that's a possibility for you as well, but you need to know some details about where you stand on this tax-wise so that you don't just sell it and then figure out, oh my gosh, we owe the IRS X amount of money.
Yeah, the key piece to that question for me is if we don't use it often, then it is a drain, and I would not keep doing what you're doing. So you can look into selling it, but you could also look into a way for it to produce income for you, and that's one way. You could look at a 1031 exchange. You could offset any taxable gain that you'd have there by going directly into a like asset. Our firm has handled 1031 exchanges for people. We can help you with this if you'd like to work with a financial advisor when you sell. And the other component would be to keep the house but begin renting it. He doesn't say anything about that, but Janet and I have had experience in that realm as well. I mean, whether it's a short-term rental, which a lake house probably would lend itself more to a short-term situation, or a long-term rental, you could create some income there, and this upkeep that's getting expensive could no longer be your problem.
Right.
You could use rental income to provide that and also potentially supplement your future retirement income. But I do believe from a real estate perspective, other than your primary residence, which still does benefit from increased value, if you have secondary real estate, especially homes, you got to have a reason to hold that includes an investment piece to it. You don't want it to be a drain on your portfolio.
Yeah, if they had traditional investments here and they just had to keep putting money into it, we know how that conversation would go. We would be, we're going to make some changes here. So I do feel like that's where you are, but just be cautious in the process that you go through to make those changes.
Our last question on today's show is from Mike in Bryant. I'm 67, retired, and my term life policy is expiring soon. Our house is paid off and the kids are grown. Do we still need life insurance? Great question, Mike. If the mortgage is gone and the kids are out, do you still need life insurance? Let's talk about coverage with a purpose, not just a premium. And we certainly believe that life insurance is needed for a certain season of life, but we also believe it's really not life insurance. It should be called income insurance, because the need for life insurance here is when you are still earning income. It is far greater of a need then than it is in retirement. And many people no longer need life insurance for income replacement in retirement. And Mike is certainly starting to check some boxes here. The kids are out of the house.
Yeah.
The house is paid off, so his expenses are lower, both from the kids being out of the house and the house being paid off. The income replacement may no longer need to be provided for with a life insurance policy.
So one of the things that you need to ask yourself, Mike, in this scenario to figure out if you need any of the income that life insurance would provide is, if you were to pass away, then what would your wife's income situation be? Obviously, one of the smaller of the two Social Security checks will stop. Will she be okay when that happens? And do you have a pension that will also stop? That's one of the key reasons that from time to time we see a reason to keep life insurance in some way. Obviously, with a term policy, you're going to come to the end of that, but you can see if you have the ability to convert that into a permanent policy. And if you have the ability to do that, and your wife would have the need for income replacement if you were not here, then you certainly need to consider it. But in most cases, we look at this time in life as a time when life insurance is not the type of insurance that is most important for most households.
Yeah, the type really, the insurance need changes from life insurance to long-term care coverage, because that is the elephant in the room when it comes to retirement planning. We do retirement income planning here at GenWealth, and our key goal is to make sure you don't run out of money before you run out of time, right? So that is going to be turning your assets into an income stream with raises over time that will support your lifestyle. If you have overfunded that part of your retirement, then you may have excess assets to set aside for long-term care coverage. But if you don't, or if it's going to be tight, then that is really the insurance need, is being able to leverage the cost of long-term care by using an insurance carrier rather than providing your care through your own means. And if it was, like you talked about, with it being a term policy, it's very likely to be expiring soon, and there'd be no reason to go through underwriting again and get a new policy. But if we kind of broaden this discussion out just a little bit for other people who may have a cash value life insurance policy or other policies that could. We talked about the 1031 exchange with the real estate. This would be a 1035 exchange with insurance that could potentially go from life insurance to long-term care.
So the concept is the same. 1031 in real estate, you're not taxed on those gains. You go from like property to like property. This is the same concept. You're going from an insurance product to an insurance product. So you could go from a cash value life insurance policy where you've realized we don't really need it for life insurance anymore, but now we have a need for long-term care. So you can go from that to an insurance policy, a life insurance policy that has a chronic care rider on it to address the needs that most people are concerned about with regard to long-term care. And I'll say, Scott, usually when we talk about long-term care, people are like, I don't want to think about a nursing home. We don't want to either. And that's the reason we encourage you to think about this type of coverage, because the purpose of long-term care coverage, whether it's a traditional policy or whether it's a life insurance policy with a chronic care rider on it, the purpose is to keep you independent and in your own home for as long as possible, and to be able to do that without depleting your assets that are intended to still be there for your spouse and hopefully for your heirs as well.
Yeah, so there's a great opportunity for you to incorporate that into your retirement planning. We do have a paraplanner on our team. His name is Jason Marshall, and he has an extensive background in insurance, so he can certainly help you determine, Mike or anybody else listening, if you have a need for any type of coverage, and if so, what type and how much. If you'd like to reach out to us to begin a life insurance review or an insurance evaluation, you can reach out to us by calling toll-free 866-653-PLAN. That's 866-653-7526. You can also send an email to info@getreadyforthefuture.com. And this insurance piece, too, when you think about it, people oftentimes they think of long-term care insurance as being the use it or lose it type, right?
Right.
You have
right.
the premiums that can go up over time. But if we can, just with a couple of minutes left that we have, talk about how those policies are kind of going away because of how expensive they are. And these life insurance products with the long-term care rider are really becoming more popular because of that level term, or that level premium, I should say.
So it's just a sign of the industry changing and responding to what people have said that they needed or wanted. My mom is 85 years old, and so the type of policy that she has, just because it's what was available at the time, is a traditional long-term care policy. If she were 20 years younger and having this conversation at that point now, then we would probably encourage her to go a different direction, because we really like the policies that are built to be life insurance policies with a chronic care rider. They're far more flexible. Somebody's going to get paid out of that, either paid through the death benefit because somebody passes away, or paid through the benefits, or a combination of both. And so we really like that, as opposed to, in my mom's case, if she just has a heart attack at some point and is gone, we will not ever get the benefit back from the premiums that she has paid in to that more traditional policy.
Well, you heard the bell. We're almost out of time on the show. I want to remind you again, for free info about retirement, investments, and your money, you can subscribe to our YouTube channel. Just go to YouTube and search for GenWealth Financial Advisors. But as for today's show, we are out of time. Great questions today. We thank everybody that brought them in. Janet, it's time for our final thoughts.
You know, we've looked at several different areas, whether it was a 1031 exchange, a 1035 exchange, all of these questions about taxes and qualified charitable distributions. I think there is so much potential complexity involved in people's lives. And I don't know about you, but I look to simplify in as many areas as possible and to get more solid answers in as many areas as possible. So if you have more questions than answers in your financial life, if you're wondering about taxes, if you're wondering about RMDs, if you're wondering about real estate, all the things that we've discussed today, we are here to put together a personalized plan for you to help you more clearly understand your retirement.
I think about, in my final thought, referencing one of our prior segments, only 6 in 10 Americans feel financially secure about retirement, according to a new study. That means 4 out of 10 do not feel secure about retirement. And when you look at why that is, a large piece to it is they don't have a relationship with a financial advisor and or they don't have a written plan. If that's you, I want to encourage you to reach out and begin the process. Go through the GenWealth Ready to Retire process with us. The first appointment is complimentary. It costs nothing to sit down and have a conversation with one of our advisors. You can do that by picking up the phone and calling 866-653-PLAN. That's 866-653-7526, or send an email to info@getreadyforthefuture.com. And that is all the time we have for this week's Get Ready for the Future show. Again, if you want to get a question in, you can leave a voicemail by calling 501-381-5228. You can also text to that same number, 501-381-5228.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com, or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.